Hey guys, welcome back. In this video, we are solving a problem from Management Accounting, June 2024 paper. Okay, and this is the 14 mark problem as in the question paper, and this is one of the comprehensive problem from marginal costing. Limiting factor problem. Okay, this is the limiting factor problem, and this is the comprehensive problem from that area. Okay, let's solve this problem. Posco Limited is manufacturing 4,000 units of products Zimzam, utilizing 100% of its machine capacity. Okay, selling price per unit and cost per unit of the product Zimzam has been given in the table. Okay, Zimzam selling price is 700 and cost debit direct material variable machinery cost has been given, which is 150, and per hour machine hour rate is 100 rupees per machine hour. Okay, so it is taking 150 hours of machine hours. Okay, and the other factory overhead cost is given. Other factory overhead cost is not termed as variable, and it is also not termed as variable, so we consider it as total other factory overhead cost and total selling and distribution cost, and it is given with the profit per unit. And then what they are saying is Posco Limited can sell Posco Limited can sell 8,000 units of product Zimzam due to limited machine hour capacity. So in this problem, what they have set as limiting factor is machine hours. Machine hours is the limiting factor. Okay, so it can produce maximum of 4,000 units of product Zimzam in-house. Okay, and then if they are purchasing from other supplier, then it can supply up to 3,000 units of product 3,000 units of product Zimzam at 620 per unit. Okay, then what they are giving is, okay, we'll put the mind map of this problem. Okay, Posco at 100%, 4,000 units of Zimzam. Okay, and then selling and all the selling details and cost sheet of Zimzam has been given. Okay, cost sheet has been given. Zimzam has a demand in the market, which is 8,000 units, right? Due to limited machine factor, he is producing 4,000 units of Zimzam, and he also have a supplier who provides Zimzam at 620 3,000 units of Zimzam at rupees 620 per unit. Okay, right? So this is one option, and this is in-house option, this is purchase option. Okay, and Posco, this is case 1. Case 2, Posco as alternate product, it can use the same 100% manufacturing facility to produce bone bond. Bone bond can have a demand of 10,000 units, and how much it can be produced is based on the machine hours that we'll find out when it comes to the problem. Okay, how much of bone bond can be produced. Okay, cost sheet given for this also, right? Then Posco Limited provides you the following information, which is variable selling and distribution overhead cost. Okay, so they have given the variable selling and distribution overhead cost, which is manufacturing product of Zimzam in-house. Okay, this variable SOH is rupees in-house, right? So 80 for this variable SOHS, rupees 60, and for bone bond in-house is variable SOH, which is rupees 70, right? Then Postco Limited uses Mission R as the basis for assigning fixed factory overheads. Okay, how much to assign the to split the fixed factory overheads. Postco uses Mission R. Postco uses Mission R, right? Okay, Mission R as a basis. Then total fixed overhead is rupees 2,40,000, right? Then these costs will not affected by the, okay, even whatever the product mix, it won't change, no change, right? Then what they have asked is suggest the best product mix quantity of each product, which is the product mix actually. That manufacturing entity of Postco Limited should manufacture or purchase to maximize its profits. Okay, they either manufacture or purchase, or in which way they can maximize its profits, right? So that's what the first question is. So in which product mix they are maximize its profits, and what's the profit of that mix. First question is profitable mix, maximum profitable mix, profit of that mix. That's it. So this is the question, and we have to work out this problem, right? So we can approach this problem with 3-step approach. First step is statement of ranking. Step 2 is allocation of limiting factor. What's the limiting factor here? That's Mission R's, right? So allocation of limiting factor. So what we do generally, if the Mission R's is limited, we should allocate the total Mission R's to the high contribution products. Okay, that's what we are going to do in this part. Okay, here we are going to find out which is the product which gives us the maximum contribution per the limiting factor. Okay, this is not contribution per unit, this is contribution per limiting factor. Based on the by taking the limiting factor as the limiting factor into consideration, what's the maximum profit we can achieve out of these two products, then we have to rank it, and we are going to allocate the limiting factors. Okay, limiting factor resource. We have a limited resource, so we have to allocate that limited resource to the products, right? So then we have to find out the profit, statement of profit. That's it, 3 steps. Okay, so quickly let's get into the problem. Step 1, statement of ranking. Okay, how many options have been given, which is two products, which is Zimzam and bone, right? What's the selling price of Zimzam? Selling price of Zimzam is 700. Selling price of bone is 700, right? Next, other things and all, variable costs. So we have to add the variable costs to find out the contribution. What's the variable cost? Direct material per unit. Direct material per unit is 100 for Zimzam, 300 for bone. Okay, next thing is variable machine operating cost. Machine operating cost, which is how much? 150 and 50. 150 and 50. Okay, let's have a question paper side by side. 1 minute. Okay, now we have kept the question paper in the left side, so it would be easy to easily plug the figures, right? So the next thing is other factory overheads, but we need the variable factory overheads, variable other factory overheads, and then they are given with the variable selling and distribution cost, but we need variable selling, and which they have given the total, so we need the variable. Okay, so after deducting all this, we'll get the closing stock. We can deduct this with contribution selling price, and we'll get the contribution per unit. With this contribution per unit, we are going to find out the contribution per machine hour. Okay, so before that, we have to find out the variable fixed overheads and variable selling overheads, right? So let's prepare the working note. For that, we need to find out what's the total machine hours taken per unit. Okay, machine hours per unit. Okay, total machine hours is for that we do have to do the machine cost divisible by machine hour rate, which is 100 rupees. So machine hour cost is 150, machine hour rate is 100, so 1.5 hours per unit actually taken. Okay, for bone, it is machine hour cost is 50, machine hour rate is 100, so it will take 0.5 hours per unit, right? So we have found the machine hours taken by unit. Machine hours taken per unit. Okay, then what else we have? Okay, if 100% capacity is 4,000 units, then 4,000 units, then we multiply it with 1.5 hours per unit, so which is actually gives us the 6,000 units of machine hours, right? 6,000 units of machine hours we got. Then what else? We got the total machine hours. Then we have the fixed factory overheads. Fixed factory overheads. Not the fixed factory overheads, that's the total factory overheads, which is rupees 2,40,000, right? See, 2,40,000. Sorry guys, this is fixed factory overheads. Okay, so fixed factory overheads is 2,40,000 divisible by 6,000 hours, which gives us 6,000, which is rupees 40 per unit is the fixed factory overhead. What's the total factory overhead? Which is rupees 180 per unit. The difference is variable factory overhead, right? So rupees 120 per unit is the variable factory overhead. So 120, right? Same we have to do for bone. Okay, fixed factory overhead is 2,40,000 divisible by this we have already have. So this is 40 per unit. So what's the total factory overhead, which is rupees 50, right? But before that, this 40 per unit is the 40 per unit fixed overhead is for the one machine hour. Okay, this is for one machine hour. So for 0.5 machine hour, which is rupees 20 per unit, right? So fixed factory overhead is 20 for 20 per unit. Total factory overhead is rupees 50 per unit. So this is given the question. See, 50 per unit. What's the variable factory overhead, which is rupees 30 per unit? So we got the variable factory overhead also, which is rupees 30, right? Then selling and distribution overhead cost, we have selling and distribution cost overhead. This is given in the box, separately they have given, so we can just plug the figures. Selling and distribution for Zimzam, see 80 for Zimzam, and 70 for bone, right? If we total the fixed cost, we'll get 100 plus 150 plus 120 plus 80, which is 450 is the variable cost. 300 plus 50 plus 330 plus 70, which is 450 is the variable cost. So 700 minus 450, which is 250 is the cost per unit. Then this is also 250 unit. So this is the cost per unit. If it divided by machine hours per unit, what's the machine hour per unit? Machine hour per unit is 1 hours per unit, 0.4. So it only takes 0.5 hours per unit. So what's the contribution per machine hour? Right, 250 divisible by 1.5, which is 166.667 is the contribution per machine hour. 250 divisible by 0.5, which is 500 is the contribution per machine hour. So we get the higher contribution in bone. So this is the first rank, this is the second rank. So we have completed the first step. Let's quickly get into the second step, which is allocation of limiting factor. Okay, allocation of limiting factor. Right. So rank, products, units, machine hours per unit, then total machine hours, then summation of machine hours, total machine hours. Okay, right. So rank 1, rank 2, product bone, then Zimzam. So what's the total demand of bone? We have 10,000 units of demand. So we produce the bone to the maximum level. So we are producing 10,000 units of bone. What's the machine hours per unit? 0.5. Total machine hours is 5,000 hours, right? 5,000 hours. What's the total machine hours the entire company is having, entire factory is having, which is 6,000 units, right? So 6,000 units, put it here. Then 1,000 hours only we can allocate to Zimzam. 1.5 is the machine hours which can be produced for every unit. So 1000 divisible by 1.5 will get the total units, which is 667 units. Okay, so this is the balancing figure, right? So we can quickly jump into the statement of profit. So we have everything. So contribution, total contribution is for bone rupees. Okay, total bone which is 10,000 units into what's the total contribution, which is 250. Okay, 10,000 into 250, which is 25 lakhs is the total contribution for bone. What for Zimzam? Both are in-house. Okay, so Zimzam can be produced only 667 units into 250, which is 1,66,750. Okay, Zimzam we can purchase from outside also, since we have how much is the demand? 8,000 units of 8,000 units of demand for Zimzam, so we can sell it out. The extra 3,000 units we can purchase from a supplier and we can sell it here. So what's the total selling price? 700. Then what's the purchasing cost of Zimzam, which is 620, right? See, 620 from quality supply, which is SB Limited. Okay, 620 minus we have a variable selling overhead of rupees 60 that has to be reduced, right? So 60, so 700 minus 620 minus 60 is 20 rupees. Okay, 3,000 into 60, so 3,000 into 20, which is 60,000 is the contribution out of Zimzam purchased from the supplier. So this is the total contribution we have, 25 lakhs plus 166,750 plus 60,000, which is 27,26,750. Okay, so total contribution we have minus what's the fixed cost? Fixed cost is the there is no change for any case of production mix. So 2,40,000 is the fixed cost minus fixed selling overhead is there, right? Fixed selling overhead actually. So this is the variable overhead. So this is the fixed overhead. Sorry, this is the total overhead. Deducting this, we'll get the fixed overhead. So 120 into how much units of Zimzam produced inside the factory is 667 plus 10,000 into manufacturing 70, and this is 30. So 30. This is 200 minus 80. This one is 100 minus 70 plus 3,000 units of, so which is, so there is no fixed cost used for the outside purchased unit. So this is it, 120 into 667, which is 8,040. Okay, 120 into 666.6666, which is okay. 3,80,000 is the value. So deduct this, we'll get the profit 750 minus 2,40,000 minus 3,80,000. So 21 lakh 6,750 is the profit. Okay, this is the problem, but we have done almost everything in a correct manner only, but the answer is not matching with the institute solution. Institute has only given the final answer, so we don't know where they have taken in which manner, so we don't know, but this is the optimum solution for this kind of problems. So we can work out like this and we can get a solution, but I don't know how the institute has solved this problem. So if you guys know anything, so you can open to text and comment, and I'll just give a recap of this problem and we'll wind up this video. Okay, this is the marginal costing limiting factor problem. What's the limiting factor here? Mishnars is the limiting factor. POSCO has two options, which is POSCO has bone and the POSCO has Zimzom. So 4,000 units of Zimzom is current production units, but in the market they have a 88,000 units of Zimzam. 8,000 units of demand they have in market, and for bone they have 10,000 units of demand. So and they have a cost sheet of bone also given, and cost sheet of Zimzam also given, and we are told that fixed factory overhead is used with the machine hour as a basis, and we found out the fixed overhead per unit, and the fixed overhead won't change at any product mix, and they asked us to find out the profitable mix and total profit of that mix. And we have split this problem into three parts, which is statement of ranking and allocation of limiting factor and statement of profit. Okay, under the statement of ranking, what we have done is we have filled the selling prices and the variable cost, and for variable overheads they have only given the total overheads. See, total overheads they have given, so we have splitted the variable and the fixed overhead here by taking the machine hour as the base quantity for the fixed factory overhead. So we have divided with that, and then we have got the rupees 40 as a fixed factory overhead. Comparing that, we'll get the 120 as the variable factory overhead. Same we did for bone also. Bone has only 0.5 hours per unit, so the fixed factory cost per unit is 20 per unit. Okay, so they are only taking half an hour per unit, so the fixed cost reduced by 20 per unit. Comparing with the total factory overhead, the variable overhead is rupees 30 per unit, right? So we have got all the information and we plugged it here, and then we divided with the machine hours. We'll get the contribution per machine hour, and we have a contribution per machine hour, which is the most contribution per machine hour is the first rank takes the first rank, and next the second rank. Okay, based on that, we have given the almost all the total machine hours to the max of to match with the actual total demand of the bone total demand is 10,000 units. So we have produced entire 10,000 with the machine hours, and apart from that, we have only 667 units of Zimzam only we can produce out of 1,000. This is go like this and come like this. Okay, we have to fill the figures of 10,000 units, 0.5 machine hours per unit. Multiply with that, we'll get the 5,000 hours, and the summation of total machine hours will end with the 6,000 hours. So difference is 1,000 hours, and the machine hours taken by Zimzam is 1.5. So when we have 1,000 machine hours plus divisible by 1.5 machine hours, so we'll get the total machine hours is this, and 1.5 hours per machine hour is this. So the maximum products we can produce out of the 1,000 hours is 667 units. Okay, and we have a total contribution. Now we have the total contribution for all the products. This is both are in-house, and this is from we have got from the supplier, and with the contribution of 20, we have sold it for, we have sold it and we got the contribution of 60,000. The total contribution is 27 lakhs 26,750. Fixed cost we have is 2,40,000. This doesn't change for any product mix. And the fixed selling and overhead distribution, right? Selling and distribution overhead, right? So for that we have at 120, which is the total selling and distribution overhead minus variable selling and distribution overhead. Will get the fixed selling and distribution overhead for both the Zimzam and Bone. We got the figures, and this total to 3,80,000. Subtracted that, we'll get the profit of 21,06,750 as profit, right? So that's it. The problem is, if you guys know any, if you guys found out any mistakes in this problem, you can comment in the problem. And if you guys know why there is a change in why there is a discrepancy with the institute solution and in my problem, I also referred some of the faculties problem also. They also know having the missing figures of this, so they are not matched with the institute answer. So if you guys have any answer, you can open to comment on the comment box. Thank you.